Hey there. This is Shahrose Shaikh, welcoming you to our YouTube channel Value Investing. Hope you are doing well. Let's start with one of the most trending investment instrument, which is called mutual fund SAHI HAI. Here in this video you will get to know what is mutual fund and how does it work. A mutual fund is an investment vehicle that pools money from multiple investors and invests it in a diversified portfolio of securities such as stocks, bonds, and other assets. It is managed by professional fund managers or investment companies. Investors buy shares in the mutual fund, and the value of their investment is determined by the performance of the underlying securities held by the fund. Here's a general overview of how a mutual fund works. Pooling of funds: investors contribute money to the mutual fund, and their investments are combined to create a large pool of capital. Professional management: experienced fund managers are responsible for making investment decisions on behalf of the mutual fund. They analyze market conditions, research potential investments, and construct a portfolio of securities that aligns with the fund's objectives. Diversification: mutual funds typically invest in a wide range of securities to spread the risk. By holding a diversified portfolio, the fund aims to reduce the impact of any individual security's performance on the overall investment. Net asset value, NAV, the value of a mutual fund's assets is calculated daily based on the current market value of the securities held in the portfolio, minus any liabilities. This value per share is known as the net asset value, NAV. Share purchases and redemptions: investors can buy or sell mutual fund shares directly from the fund at the NAV price. When an investor purchases shares, new units are created, and when shares are sold, they are redeemed or cancelled. Fees and expenses: mutual funds charge various fees to cover operational costs, management fees, and other expenses. These fees can include sales charges, front-end or back-end loads, management fees, administrative expenses, and 12b-1 fees, marketing and distribution expenses. Income and capital gains: mutual funds generate income from dividends, interest, and capital gains from the sale of securities within the portfolio. This income is generally distributed to investors in the form of dividends or reinvested back into the fund. Performance tracking: the performance of a mutual fund is measured by comparing its returns to a relevant benchmark or index. Investors can track the fund's performance through regular updates and reports provided by the fund company. It is important to note that investing in mutual funds carries risks, including the potential loss of principal. The performance of mutual funds can fluctuate based on market conditions and the success of the underlying investments. So now let us talk about the pros and cons of investing in mutual fund. Investing in mutual funds offers several pros and cons. Let's explore them. These are the advantages of investing in mutual funds. Professional management: mutual funds are managed by experienced investment professionals, who make investment decisions on behalf of the fund. This expertise can be beneficial for investors who lack the time, knowledge, or resources to manage their investments actively. Diversification: mutual funds typically hold a diversified portfolio of securities. This diversification helps spread the risk across different assets and reduces the impact of poor performance by any individual security. It can be challenging for individual investors to achieve this level of diversification on their own. Liquidity: mutual fund shares can be easily bought or sold, providing investors with liquidity. Investors can typically redeem their shares at any time, allowing them to access their money quickly compared to other investments, such as real estate or individual stocks. Affordability: mutual funds often have lower investment minimums compared to certain other investment options. This allows investors to get started with smaller amounts of money. Variety of investment options: mutual funds offer a wide range of investment options to suit different investment goals, risk tolerances, and time horizons. There are funds that focus on stocks, bonds, specific industries, geographical regions, or asset classes, giving investors the flexibility to choose funds that align with their preferences. Now, let's see some drawbacks of investing in mutual funds. Fees and expenses: mutual funds charge various fees and expenses, including management fees, sales charges, loads, administrative costs, and 12b-1 fees. These fees can eat into the overall returns and vary between different funds. It's important for investors to carefully review and understand the fees associated with a mutual fund. Lack of control: when investing in a mutual fund, investors delegate the decision-making process to the fund manager. This means that investors have limited control over individual investment decisions. The performance of the fund is dependent on the expertise and decisions of the fund manager. Capital gains taxes: mutual funds distribute capital gains to investors when securities within the fund's portfolio are sold at a profit. These capital gains are taxable to the investors, even if they did not sell their shares. Depending on the tax laws in their jurisdiction, investors may be subject to capital gains taxes on their mutual fund investments. 4. Over-diversification: while diversification is generally an advantage, some mutual funds can become overly diversified, holding a large number of securities. This can potentially lead to diluted returns, as the impact of strong performers may be diminished by weaker ones. Market risks: like any investment, mutual funds are subject to market risks. The value of the fund can fluctuate based on changes in the market conditions and the performance of the underlying securities. There is always a potential for loss of principal. It's crucial for investors to carefully consider their investment goals, risk tolerance, and personal circumstances before investing in mutual funds. Conducting thorough research, reviewing fund prospectuses, and consulting with a financial advisor can help investors make informed decisions. Investors should carefully read the fund's prospectus if they are thinking about investing without consulting with a financial advisor. Thanks for watching. Don't forget to like this video and subscribe to this channel for more useful investment ideas. Bye for now.